All right, Accounting 2 kiddos, welcome to your last chapter, 24, in our first book. You'll be transitioning over to our red ones after this very short chapter. Chapter 24 is on recording international sales and then also on recording internet sales. So we do need to spend a little bit of time trying to understand the differences between international and domestic sales. So it is a little heavy on the lecture side of things this time, but important stuff you'll need to know before we head over and do our work together. So with international sales, the fact that they have begun to expand majorly as a source of revenue for both small and large businesses is something to take note of. The main reason that that is happening is simply because of the growth of technology has made it easier and less expensive to do those transactions internationally. So we have two types of goods and services. We have goods and services that are shipped out of a seller's home company or a home country to another country. We call that exporting when we ship it out. Goods and services shipped into a buyer's home country from another country are called imports. So we either are exporting goods and services or we are importing goods and services. And it is important to know the difference between those two. Now, a company that conducts business across any sort of national border, it could be even US to Canada, US to Mexico, even though we border those, it does not matter. As long as we cross a national border, we are considered an international company. Now, our company, which is called Must Have Gadgets, they import merchandise like digital cameras and cell phones from a variety of countries, and we also export electronic gadgets like earphones and tablet covers to customers around the world. If a company chooses to just sell to individuals or other businesses within their own country, we refer to that as domestic sales. Domestic just meaning inside our own borders. Now, most domestic sales are for cash or on account, which is what we've done so far throughout all of Accounting 1 and your beginning part of Accounting 2. We've only done domestic sales. However, the reason that we are allowed to do that, either for cash or on account, is simply because in the United States, all transactions that are involved in commerce are covered by something called the Universal Commercial Laws. And they also typically all follow the same accounting standards or GAAP. So many of our transactions are based on trust, meaning we know that we're going to get paid cash or we know that we're going to get paid on account. When it comes to dealing with international sales, there are several complexities that we need to talk about because they could cause issues. So the fact that there is a lack of a universal commercial laws makes trying to settle disputes, if disputes do arise between companies, more difficult. You're also traveling greater distances, which obviously increases the time needed to complete transactions. Um, there could be more complex transportation methods. You might need to fly things there. You might need to ship things there. It could be driving, whatever it happens to be that has to do with a higher cost of shipping. It also can also increase the time needed to complete those transactions. Um, there always is a risk of uncollected amounts that goes higher when we're talking about internationally. So it could be difficult for us to try to determine a customer's financial condition, or if we need to take legal action, we would be crossing over international borders. And then we also could have unstable political conditions, which could affect our ability to receive payment or make payments. Now, because of all the issues we just listed, most businesses, when doing either exports or imports, are going to follow the same general process in international trade to make sure that the vendor gets the payment and then obviously that the customer gets the merchandise. So it's going to be similar. There could be some differences, but we're going to follow this same general guideline. So the first thing that needs to happen is there's going to be a contract drawn up called a contract of sale. And what that is it's a document that details all the terms that are agreed to by both a seller and a buyer. So what's going to go in this contract is obviously a description and the quantity of merchandise, the price, the point of delivery, so where exactly are those goods being delivered to, the packing and marking instructions, so how is these goods going to be packaged, shipping information. Is the merchandise going to be insured since you're crossing international borders? And then also, what is the method of payment going to be? So typically, the reason why we do a contract for sale when we're doing internationally is just to make sure that everyone is on the same page. It eliminates confusion. It makes everything very straightforward. Obviously, if you were crossing borders and your language is different, you would have these done in both languages, so we would understand um, uh, that both companies would be able to understand what they're agreeing to. So our must-have gadgets, which is located in Plano, Texas, contracts to sell merchandise to Serrano Company in Sao Paulo, Brazil. So must-have gadgets is exporting, and Serrano Company would be importing. So the contract price is $6,000 in or 6,000 US dollars, and the merchandise is supposed to be delivered to Sao Paulo. Serrano Company, which is the company out of Brazil, is set to pay the transportation charges to get those goods, which is relatively common. So once they've drawn up that contract of sale, then what happens is a letter of credit is issued. And a letter of credit is a letter that gets issued by a bank guaranteeing that the named individual or a business will be paid the specified amount provided um, in the state if the stated conditions are met. So the contract of sale between Must Have Gadgets and Serrano specifies that the letter of credit is going to be the method of payment from Serrano to Must Have. So a letter of credit is kind of known worldwide as sort of a risk management tool for international transactions. It's a way to assure uh, payment because it has to be verified by the bank before they're allowed to issue that letter of credit. So what happens is that Serrano, which is the company in Brazil, prepares an application with its bank, the Banco de Rio. I'm not in Spanish, so pardon me if I'm pronouncing everything wrong, to issue their letter of credit. So Serrano's bank approves their application and issues the letter of credit, and then Serrano's bank forwards that to the Must Have Gadgets Bank in First Bank of Plano in Texas. Um, when First Bank gets the letter, they deliver it to Must Have Gadgets, and once Must Have Gadgets reviews that letter to ensure that everything is correct, then they are allowed to ship the merchandise. So you can see it takes some time. International sales take time. They're not something that happens immediately. You don't just click a button, buy, and then ship. Okay, because you're crossing those borders, because all of those different complexities can happen, it's a time sensitive process. So, in order for Must Have Gadgets to get their payment, there are three documents that have to be specified and created that it says in their letter of credit that have to be submitted to their bank, the First Bank of Plano, Texas. So, one is a bill of lading, a commercial invoice, and then a draft. So, we're going to talk about each one of those. So a bill of lading is technically just a receipt that's signed by an authorized agent of a transportation company. So remember that typically what's happening is that neither Must Have Gadgets nor Serrano Company is the one actually transporting the goods. They hire a transportation company to do that. So this transportation company is the authorized agent in charge of shipping this merchandise, and that it also serves as a contract for delivery of that merchandise. We call that the bill of lading. So the transportation company sends the bill of lading to Must Have Gadgets when the merchandise gets shipped. Must Have Gadgets then, because they have shipped the stuff, ends up preparing these two other documents. The two other documents is a commercial invoice, which is simply a statement prepared by the seller, which is Must Have Gadgets, um, and it's addressed to the buyer, showing a detailed listing and description of the merchandise sold, prices, and terms. That's all it is. It's just called we just call it a commercial invoice. You've heard it before as a sales invoice. When we're going internationally, we call it commercial. The second thing that they create is a draft. A draft is simply a written, signed, and dated order from one party ordering another party, that's typically a bank, to pay money to the third party. So a draft can also be referred to as a bill of exchange. Um, a draft payable on site when the holder presents it, we call that a site draft. A site draft just means that it's going to be paid right away. As long as all of the other documents that are needed have been provided, a site draft means that they would get paid right away. So once received, First Bank, remember, which is Must Have Gadget Bank, examines all of those documents to ensure that all of the terms of sale are in compliance with their letter of credit. When they do that, First Bank then forwards the documents off to Serrano's bank. Remember the Banco do Rio. Okay. Banco do Rio then also examines the documents to make sure they are in compliance. So again, remember, this takes time. First, the Must Have Gadgets checks everything. Then their bank checks everything. Then they send it to the other company's bank. Then that company's bank sends it back to their company. And it just, everything takes time to get checked. Okay. Once Banco do Rio determines that all those documents are compliant, only then does it actually deduct the amount of that site draft or the single draft from Serrano's account and sends that $6,000 back to Must Have Gadgets Bank. So it could easily take up to a week or a week and a half for everything to go through. It could even take longer than that. But making sure that everything gets in compliance is one of the things where I said it takes time in order to make an international sale. So when it comes to actually journalizing that international sale, after receiving the payment from Banco do Rio, First Bank deposits that payment for the sale into Must Have Gadget's account. It then sends Must Have Gadget the deposit slip for that amount, remember the $6,000. And since there wasn't actually a receipt, they didn't receive a check, anything like that, what happens is Must Have Gadget prepares a memorandum, because remember, we have to have a source document. And after that, the sale is actually just recorded as a cash sale, which would go in our cash receipts journal, looking just like this. So we simply put our check mark. Just remember that your document number is going to be a memorandum, M45. And then there's nothing that goes in our general debit, general credit. Sales goes up by a credit of $6,000 and cash goes up by a debit of $6,000. So pretty easy peasy there in terms of recording an international sale. The next one is journalizing something called a time draft. So if, for example, Must Have Gadgets sells $7,000 worth of merchandise to a Ramirez company that's located in, I have no idea how to say that, someplace in Mexico. The contract of sale is similar to the contract with Serrano, except with one exception. Must Have Gadgets agrees to a delay of receipt of payment. So instead of doing a site draft, remember a site draft is as soon as they receive it, they make the payment. When a company gives that delay of receipt, essentially what they're doing is giving a time draft. So a time draft is simply a draft that's payable at a fixed or determinable amount of time, some date in the future. Okay. What that looks like then is the sales process is the same, except that they're not actually receiving cash at this point in time. So what happens is we have this new account. It's called Time Drafts Receivable. Again, it's very similar to our accounts receivable. It's just that we haven't, it's an asset. We just haven't received actual cash yet. So Time Drafts Receivable goes up, sales goes up, and this goes in our general journal, because remember at this point we have not received cash yet. So we put the date, Time Drafts Receivable. Our source document number is TD for time draft number 12. And then our sales goes up with a credit. So that actually goes in our general journal because it can't go in cash receipts, can't go in cash payments. It's not a purchases, any sort of those things. So when we actually do receive the money from a time draft, what happens is it looks very similar to when we receive payment from our Serrano company. So what that looks like is it goes in our cash payments. It's just that time drafts receivable, which is an asset, when it decreases, which that little arrow should be flipped, it goes down with a credit of 7,000. So here, when we actually receive the money, we credit that asset, that goes down, and our cash goes up with a debit. Pretty simple. The last thing I just want to mention is that there is such a thing called a trade acceptance. A trade acceptance is simply just a form signed by a buyer at the time of sale, promising to pay a specified sum of money, usually at a date in the future. The reason we don't do this internationally is just that we don't know our buyers as well.